Will CPIs confirm a disinflation trend across Europe? Welcome to Market Insight. I'm Ludovica Brignola. The battle against inflation seems mostly won in Europe, with some ECB policymakers now growing increasingly worried about too low inflation. Will the upcoming CPIs confirm the trend this week, and how should the ECB act? Well, to help answer all that and more, I'm joined by Tim Graf, Head of Macro Strategy EMEA State Street. Thank you very much, Tim, for being with us today on the programme. Right, so headline inflation at least is now back well below the targeted 2%. Can we say that inflation has been defeated in Europe, and what do you expect from the upcoming CPIs?
I think we can say that it's certainly normalized, and I think more importantly, you can start to think that as well about core inflation. Headline inflation has been back, as you mentioned, to target for a couple of months now. Core inflation actually looks like it's going to get there sooner than I think the ECB even expects. We have measures of prices captured through online retailers. And actually for October, it's shaping up to be one of the weakest Octobers on record. October typically, seasonally, is not that weak. We're seeing actually quite a bit of weakness. And actually it introduces downside risks to the forecasts for core inflation that the ECB just updated in September. So yeah, I think we are very much getting there. We're already there on headline and we're getting there on core.
Very interesting on the core inflation front, and some have suggested that a return to zero rates in Europe is now becoming a possibility. Do you agree, and why?
I don't agree just yet. The growth slowdown is certainly there. I think it argues for easy policy, which means probably rates, I think, winding up closer to 1.5%. That should be enough below neutral to start to stimulate growth again. I don't think the ECB or any central bank for that matter really wants to go back to the era of zero rates unless it is absolutely necessary, and that requires, a real growth shock. And we're not there. Growth is weak, growth is slowing, but this is not COVID. This is not the global financial crisis. It's not something that argues for such extreme policy settings. All it really argues for is easy policy settings, and that's where I think 1 to 1.5% on policy rates makes sense.
Right, growth is weak and slowing. And what about Germany's struggles? Because they are now dragging on the wider bloc's fortunes in a way. And tomorrow we have GDP for Germany expected to slow further, CPI expected to rise after it was flat in September. What's your view on the German economy? What do you expect?
I think the struggles are pretty well known. They're probably priced to a degree, but I think some of the optimism you might hope for, whether it's from China stimulus or easier ECB policy, these are going to be things that are going to be very slow to materialize and to boost the German economy. And at the same time, Germany has a domestic demand problem, and all of this is interrelated. But nevertheless, I think it argues against expecting any sharp recovery anytime soon, not least until we get further clarification on Chinese stimulus, which can hopefully stimulate the export sector in Germany, but also easier domestic conditions. I think we need to keep coming back to that because the inflation picture I discussed for the Eurozone is very, very similar for Germany, and it speaks to a much weaker demand environment that argues for easier policy. But the lagged effects of that are going to take time to materialize.
Right, at this point, is there a real potential for a 50 basis points cut down the line for the next ECB meeting? And what would this impact would this have on bond yields and the euro as well?
Sure, yeah, I think that's a real possibility. If not in December, by January. There's a small potential for that that's priced into rate markets, about 40% priced in December and 35% priced in January. I think that needs to be a majority pricing, above 50% at this point, given the inflation dynamics I've discussed, but also given that the door to larger cuts is open. We saw the Bank of Canada ease rates by 50 basis points last week, trying to get rates to easy territory much more quickly. I think there's a possibility that the Swedish Riksbank will do that after weak growth data there. The Fed, of course, has done it as well, although I think you could argue that was more catch-up, having wanted to start the easing cycle earlier. But I think that door is certainly open, and I think that possibility needs to be priced. And I think that weighs on the euro further. It's already been weighed down by falling rate expectations, but I think that spells for further weakness.
Tim Graf, thank you very much for being with us today. And that is your Market Insight. Don't forget, you can watch more videos on Reuters.com.